Today we're diving into the storm surrounding Ginkgo Bioworks. Cathie and Ark Invest have started offloading their shares, and it's causing quite a stir. Ginkgo's revenue estimates just took another hit after a recent guidance cut from management. Despite the stock's nosedive, Ginkgo faces bleak growth prospects, a high valuation, and the looming threat of a reverse stock split. Earlier this year, Ginkgo's disappointing first-quarter earnings were a red flag. The company, which specializes in cell programming and biosecurity, reported a major revenue miss and slashed its 2024 forecast. This set the stage for Monday's sell-off by Ark Invest, further shaking investor confidence. But there's more. Ginkgo is pivoting away from its original business model of owning intellectual property and reaping downstream value. This shift signals deep strategic issues as customers are hesitant to give up their IP rights. The company is now looking more like a traditional CRO, which means its valuation needs a serious reality check. The stock has already plummeted 30% since our last update. Management's reorganization plan, including significant layoffs, suggests that revenue isn't bouncing back anytime soon. With Ark Invest still holding a significant chunk of shares, further sell-offs could add even more pressure. So what's next for Ginkgo? Can they turn things around, or are we looking at another major flop? Stay tuned as we break down the details and what this means for your portfolio. Cathie and Ark Invest have begun selling their shares in Ginkgo Bioworks, adding to the recent selling pressure on the company's stock. Ginkgo's revenue estimates have taken another hit following a recent guidance cut from management. Despite the declining stock price, Ginkgo continues to grapple with bleak growth prospects, a high valuation, and the looming possibility of a reverse stock split. Earlier this year in May, concerns about Ginkgo Bioworks, a company specializing in cell programming and biosecurity, were highlighted following another significant revenue warning. The company had already disappointed investors multiple times regarding sales growth, and their Q1 results were no exception. The report revealed a substantial miss and a sharp reduction in the 2024 forecast. At that time, it was suggested that if a major supporter decided to withdraw, it could trigger further selling. This process appeared to begin on Monday when Cathie Ark Invest started offloading their shares. Ginkgo Bioworks' first-quarter earnings were disappointing, with both revenue and guidance falling short of expectations. More concerning, however, is the company's pivot in its business model, which signals deeper issues. Ginkgo is moving away from owning intellectual property, IP, and participating in downstream value, a shift that undermines the original investment thesis for the company. This pivot is particularly troubling as it suggests significant strategic challenges, especially with Ginkgo's increasing focus on more mature pharmaceutical and biotech customers. The decision to shift away from IP ownership and downstream participation seems to stem from a recognition that customers are reluctant to give up IP and downstream value, which has hindered Ginkgo's business growth. Notably, Ginkgo hasn't recognized meaningful downstream value in over 18 months, and its cell engineering services revenue has been stagnant for the past 2 years. This strategic shift undermines Ginkgo's narrative for two main reasons. First, the business model was supposed to provide royalties on a wide range of economic activities. Second, it was expected that Ginkgo's operations would improve with scale as it generated more data. Both of these assumptions now appear to be in question. There are several reasons for ongoing skepticism about Ginkgo. The company caught attention back in 2022 when Ark Invest began building a large position. Despite this interest, there were immediate concerns about the strategic moves by Ginkgo's management and their apparent struggles with revenue growth. These issues only became more pronounced over time. Alongside worries about revenue, there were also concerns about Ginkgo's substantial losses and high cash burn, although their balance sheet had remained relatively stable up to that point. The recommendation to sell came last year, after Ginkgo issued a revenue warning in its Q2 report. The company cited the timing of revenue recognition and a challenging economic environment as factors affecting its performance. Since then, the stock has plummeted nearly 80%, while the S&P 500 has risen more than 22%. Ginkgo Bioworks is facing significant challenges, including losing major supporters, reduced revenue estimates, and a struggling stock price. These issues, combined with poor growth prospects and potential financial restructuring, make the outlook for the company quite grim. Previously, the company had high hopes for significant growth as it planned to go public through a SPAC. The pandemic gave a temporary boost to Ginkgo's biosecurity segment, particularly with COVID testing in schools, but that revenue is mostly dried up. In their Q1 report this year, Ginkgo revised its 2024 revenue expectations for cell engineering services to between $120 million and $140 million, reducing both ends of the range by $45 million. The cell engineering segment was intended to be the primary growth driver for Ginkgo over the current decade. The company's goal is to simplify biology by programming cells, enabling customers to create impactful products across various industries. However, the development of new cell programs has lagged behind expectations, and customers have been slow to adopt this technology. Originally, Ginkgo management anticipated well over $600 million in total revenue for this year, but over the past 3 years, they have repeatedly lowered their guidance. Consequently, analyst estimates have plummeted, has dropped from over $5.5 billion to less than $1.4 billion. During the Q1 report, management outlined a reorganization plan which included significant job cuts to reduce net losses and improve cash burn. On Monday, the company updated this plan, stating that headcount reductions would increase from at least 25% to at least 35%. This indicates that the revenue outlook is not improving. As of the end of the first quarter, Ginkgo had $840 million in cash and cash equivalents, though this was down about $100 million from the previous quarter. Despite a relatively stable balance sheet, the company's cash burn from operations was more than $336 million in 2023 alone, and it is still years away from becoming cash flow positive. A capital raise could help long-term prospects but would be highly dilutive given the plummeting share price. Earlier coverage noted that Cathie Wood's firm, Ark Invest, had accumulated nearly 183 million shares of Ginkgo across its active ETFs, with about 70% in the flagship Ark Innovation ETF, ARKK, and the rest in the Ark Genomic Revolution ETF, ARKG. This holding represented just under 11% of Ginkgo's Class A shares. Ark also owned some shares in its venture fund, but those positions are only updated monthly, so exact numbers were unclear. It was suggested that any decision by Ark Invest to sell could trigger significant selling pressure on Ginkgo shares. Since that initial coverage, Ark Invest's position decreased by nearly 10 million shares as of last Friday, primarily due to a wave of redemptions in the two ETFs, not a change in strategy. However, on Monday, with Ginkgo's stock hitting a new all-time low, Cathie Wood and her firm began significantly reducing their holdings. The sale of over 41.5 million shares by Cathie Wood and her firm, Ark Invest, has undoubtedly contributed to the recent selling pressure on Ginkgo Bioworks. Despite this large sell-off, Ark Invest still holds nearly 132 million shares in their two active ETFs, while Ginkgo saw a significant trading volume of over 157 million shares on Monday, which was the largest in some time. The 3-month average volume was under 44 million. This means it could take several days for Ark Invest to completely exit their position. The valuation remains a significant issue for Ginkgo. The average price-to-sales ratio for companies in the S&P 500 is currently in the high 2s based on this year's sales estimates. Many biotech firms trade at much higher multiples due to their potential for substantial revenue growth. Even with Ginkgo's shares falling to new lows, the stock is still trading at around 4.5 times its expected revenue for this year, despite not showing any top-line growth. Given these factors, it's hard to justify even a hold rating at this price, especially since Ark Invest appears poised to offload a significant number of shares. With Ginkgo's shares also approaching zero, the likelihood of a reverse split is increasing, which could be another negative catalyst. Previously, it was noted that Ginkgo's valuation was high considering its cash burn and modest growth. Since that analysis, the stock has dropped about 30%. Given the recent developments, it seems that Ginkgo is moving towards a traditional contract research organization, CRO business model, which should be valued accordingly. This shift suggests that the company is facing substantial strategic and operational challenges. The change in strategy likely reflects the realization that customers prefer not to part with their IP and downstream value, which has limited Ginkgo's growth. This strategic pivot indicates that Ginkgo's original business model, which promised significant royalties and benefits from scaling, is no longer viable. Consequently, the company's valuation should be adjusted to reflect its new CRO-like business model. There are two potential upsides in the mid to long term. First, if management can reduce losses and cash burn sufficiently, they could eventually focus on revenue growth again. However, this will take time as layoffs are expected to continue into 2025, and near-term revenue growth prospects are bleak after the latest guidance cut. The other possibility is a buyout by a larger, well-capitalized player who can afford to take a gamble on this speculative space. However, with the stock dropping almost daily, a buyout seems unlikely until the shares stabilize. Just as investors avoid catching a falling knife with a dropping stock, potential acquirers might be hesitant as well. Since the last coverage of Ginkgo Bioworks, the shares have lost more than half their value after another major revenue warning caused further drops in analyst estimates. On Monday, Cathie and Ark Invest began selling part of their large stake, pushing the shares to a new low. With less than a quarter of Ark's position sold, further reductions by the two active ETFs could continue to pressure the stock. Even with shares hitting new lows, a sell rating is maintained due to the high valuation amidst revenue troubles and the expectation of a reverse split announcement in the near future. Ark Invest is likely to continue adding to the selling pressure, providing no reason for optimism at this time. It now seems that Ginkgo will join Invitae, which declared bankruptcy, and 2U, TBOU, which issued a going concern warning as the third stock this year that Cathie has finally bailed on, taking a massive loss at a price below 50 cents a share. Ginkgo Bioworks' recent earnings report and strategic pivot raised significant concerns about the company's future. The shift away from IP ownership and downstream participation undermines the original investment thesis and suggests deeper strategic issues. With the stock already down 30% since the last analysis and the company facing substantial challenges, it's clear that Ginkgo needs to be reassessed and valued based on its new direction as a traditional CRO.